All right, stocks finished the week on a really sour note. This was a really important week for equities because of the earnings season, right? A lot of the large cap tech names coming out with earnings throughout the week. A lot of Twitter news and everything associated with that. And the markets, and it was also the end of the month, the end of April. You had tax season earlier this month. So it was quite an important week, to say the least, going into next week with the FOMC meeting. And boy, the markets just didn't like what it saw. So I think it's anticipating it. You're kind of getting a buy the rumor, sell the news, or in this case, sell the rumor, buy the news as we approach what is widely expected to be a 50 basis point cut next week, and whatever may come out of that. So we're going to break down this week and break down from a technical perspective what we can expect to see next week. Are we going to see more bleeding next week, regardless of what the FOMC does? Is the technical environment set up for that? So I'm going to break that down and what we should see. We're also going to break down some really interesting moves. Kind of like the dollars had a really strong week, but you wouldn't think it if you looked at a bunch of other asset classes and sector performances. So I'm going to break that down and what the implications of that is. And then we're also going to take a look at a trade idea of a stock that's breaking what may very well be like a 5-year support, and talk about how to trade that really aggressively. So let's go ahead and get started. Today is Friday, April the 29th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicators we always do. You can see we are now down nearly 7% below the 30-day moving average, with today's drop closing easily below the 23% retracement level this time. After kind of doing it, the last few times, still getting below. You notice we still haven't closed below the low, though, of that February 24th low point. It's not technically a long lower shadow, though psychologically it's the same thing when you gap down like that and then you rally pretty much throughout the rest of the day. So it would be a long lower shadow on the futures. If you look at the futures contract that trades, you can see it was a long lower shadow there. So psychologically it's the same thing. There's going to be support there, and that's what we're at right now. We've multiple attempts at breaking that 23% retracement level since we moved that high point to the high point of the Fibonacci lines. But now there's still some support here, and you notice again over here the lowest we got to was 6.68% below the 30-day moving average. That was on this day right here, January 27th, and now we are 6.88. Now, granted, there's no limit as to how far. I mean, obviously you can go to zero, but there's technically no limit. I mean, we were down over 20% below the 30-day moving average in the COVID drop. At the very end of 2018, we got to 11% below the 30-day moving average. We were really going parabolic there. We're not necessarily going parabolic now. So if I were to throw on a line here at 6.88, just to kind of give you an idea of how often we are this far below the moving average, you can see it's not very often, right? I mean, obviously a correction, and that was a correction, and then the other times there, let me go back 20 years. So you have those corrections, the 15-16 correction you just saw, right? There's the 15-16. We went a little bit below that at the very beginning of 15. Down to that 10% mark. No, none of these other times. You can see in 2011 with the credit downgrade and that correction, we were 9.5%, or 13% below, so 14% at one point. All the other times about this level. 2010 we got down about this far, and then of course the bear market when things really hit the fan. But you remember the bear market started with this correction. That was a correction first. And this is about as far as we got down, and then and then we had our failed correction bounce, and then the bear market started right there in about June, July of 2008. So, but it didn't really hit the fan until at the end, and of course going all the way back to 2002, 2003, when things really hit the fan in 2002. That was the equivalent to 2008 for the market, was 2002 here in July, September. Let me go out a little bit further so you can see that a little bit better. Give it a second to finish loading up here. So going back out to 2002, so that was your equivalent to 2008, and we got down, 10% plus, and then And then there in 2003, this was your March 2009 equivalent, the subsequent bounce there. So you can kind of see that's, and again, that bear market didn't start until you had your correction way over here, and you had these type, 7%, 7 to 8% below the 30-day moving average. So needless to say, we are pretty significantly below the 30-day moving average. We're pretty oversold from that perspective. The intermediate line itself is almost below the 10th percentile. In fact, barring a dramatic rise on Monday, and we will get a 2-3% rally Monday or Tuesday, early next week, right? We'll probably get a even if it's an intraday, right? So we had a 2% intraday rally there on the April 25th, and then of course yesterday's big move. So it'll either be intraday like it was on the 25th, or throughout the day like it was yesterday. But because of this move, we'll get a pretty decent rally to the upside. The near-term line still hasn't gotten into bullish territory, so we still don't have a bull. This isn't a bullish near-term run. This is still a big near-term drop that we're on right now, and the ranges are just getting bigger. Obviously, it's Friday, so that means we have a weekly candle here. The near-term line is well below the 10th percentile. In fact, the near-term line is at extreme lows. So again, this suggests that we're probably going to get a pretty decent week next week to the upside. We are 8% below the 30-week moving average, as you can see. That's again, you can gauge from on all the corrections are right about this level or lower. Even 15 and 16 about as far down as it got to, and then there's 2011. So correction, and now we're in a correction. Bear market. You see how a bear market separates itself from corrections, right? That's what a bear market is. That is not a bear market, no matter how much you drop, right? No matter what the percentage is. But again, you get your near-term line, you get your momentum line so extremely low. I would expect that we're going to get a short-term bounce next week. We might start the week down, right? We might gap down Monday morning. We might start the week down, but we're going to get a pretty decent up move sometime, and maybe even finish to get the momentum line up out of this extreme lows. Of course, it's also the end of the month, which means we have a monthly candle, and you can see the momentum line is at an extreme low there, very, very extreme low. Which, you can see there's been other instances that we've been this extremely low, below the 5th percentile on the momentum line, or below the 10th percentile. There is September 21st. And then, of course, looking back over here, May of 2019. May of 2019, for the market scholars, our premium subscribers, that was a very similar time to what we have right now. In that particular period, May of 2019, we finished at the low of the month, right? We finished right at the low of the month, brought the momentum line down. If you look at the weekly chart on May of 2019, so right over here, there's the week that we ended. The momentum line finished extremely low. The near-term line finished below the 10th percentile. Again, kind of very similar to what we have right now. And then when you look at it on a daily basis, you'll notice that May of 2019. Right there that we finished. So there's the last day in May with a cluster, and you had your intermediate line below the 10th percentile on the daily chart. It was at the 7th. We don't quite have a cluster now, though we came close to one a few days ago, and we did get one on the NASDAQ a few days ago. But your intermediate line is below the 12th percentile now. Your NASDAQ, you can see again, we got that cluster a few days ago. Your intermediate line is below the 10th percentile, and then your Russell 2000. Same thing, we did get the intermediate cluster, a couple days ago, and again, the intermediate line is below the 10th percentile. So again, that sets up for a little bit of a bounce, right? That's kind of the nature of this setup. Again, I don't think we're going to be, I don't even think you're going to get that kind of a bounce, right? You had an intermediate, that bounce turned into a full-on bullish intermediate run. I don't think we're going to get that much. You're breaking support. You broke that 38% retracement level. That's a pretty significant break of support on the NASDAQ. The Russell 2000, you also broke support. You broke below the long lower shadow on February 24th on the Russell. You've broken that 38% retracement. That's support break. NASDAQ, same thing. There's that long lower shadow from February 24th. Again, we open down there, so you don't see it, but the futures, you can see it. We closed below that line That's pretty bearish. But we're so extended that we'll probably move back up to that 78% retracement, if not all the way back up to the 62% retracement first, before we move back down to the downside, in my opinion. I think you're going to get some noise. Now, we might continue to break down. I just think it's unlikely. I think we might gap down first, and any selling we get will be very bearish initially, early in the week. And then, like I said, we're going to replicate, like we always do, we'll probably replicate that size of a down move to the upside, right? Every time you get a big move to the downside, you get almost as big of a move to the upside. Not quite, but almost as big of a move to the upside. Same thing here. You get a big move to the downside, you get almost as big a move to the upside. Big move to the downside, big move to the upside. Big move to the downside, big move to the upside. Big move to the downside, big move to the upside. Now you notice it might be a couple. It might be a couple here, a couple there. There's a couple there. So we might, get another down day on Monday and or Tuesday. But then at some point in time, we will move quite a bit higher. You can see that was a pretty significant gap to the downside that we had today. And then, again, we kind of filled in some of it, but not as much. We'll come back to this chart here in just a minute. Let's take a look now at the other weekly chart. This chart's pretty bearish. It's a bearish Hakunashi close. We closed below the low point of the past week. That is a Hakunashi, yep. So we closed below that. You can see closing below the 23% retracement. The 10-week is crossing the 40-week, which again typically means that we'll bounce back up, right? You typically bounce, the death cross becomes a deal, and then you bounce whenever everybody's talking about death cross. So in this case, you're getting a 10-40-week death cross, which means we're going to come back up and probably test at least 4280. That 23% retracement before we roll back over. That's 150 points to the upside to get to 4280 before you roll back over to the downside. That's the S&P. You can see the NASDAQ, again, very bearish candle closing below the low. But you notice, over the last however many years this is, 3 years, that's the lowest the PPO has been. In fact, going over 20 years, you can see, again, look at the COVID. We are about as low right now. The gap between the 10 and the 40 is as low right now as it was during the COVID drop for the Qs. Same thing with 15 and 16 and lower than what we saw in 2011. So, again, there's your first correction. That was the correction in early 2008. There's your correction, your failed correction bounce, and then the bear market, right? So, we're pretty much in, it's pretty confirmed. If you didn't believe me before, after pretty much all year long talking about that we're in a correction, we are. Hopefully you believe me now. You can see, again, bearish candle here on the Russell, closing below a lot of low points. Just not that one right there on February, that February 24th low on the Hakunashi. Remember, the actual close is below that low point. The Hakunashi is not quite yet. But again, you can see the PPO. So now you notice the PPO. The MACD did get much lower on the COVID. Didn't on the NASDAQ, but it did on the Russell. There's your fourth quarter 2018 correction. There's the 15-16 correction. And then there's your 2011 correction. So you can see the Russell has actually gotten deeper on its normal corrections than 5%. Right about the 7.5%. Then there's your correction there. Again, about 7.5%. There's your failed correction bounce. And then there's your bear market. So we still, according to this, we still have some room for that 10 to 40 week gap to widen out to a few more percentage points there on the Russell 2000. Let's take a look at the 3 green arrow charts. You can see pink shading across the board. We have 3 red arrows everywhere, nowhere near a green arrow. More than likely, that green arrow is probably going to come from the stochastics first, because you're in the lower reversal zone of all of them. You're in strong bearish territory in all 4 stochastics. Looking at the 2 line versions, well below moving averages. So we are just in good volume. Above the first time we've been above the 1.5% mark since way back over here. And again, that kind of marked the low point. That day was actually a bullish day that we had that much volume, and that ended up marking the low point there. But well below the moving average again. You can see if I were to put the price compared to the 17-day, we're pretty low, right? That usually means they're going to ramp back up to the 17 days. So don't be surprised. Again, sometime next week, it might be Wednesday, it might be intraday Monday first, it might be Tuesday or Wednesday, but we're going to get a pretty decent 2-3%, maybe a couple of them, to work our way back up towards that 17-day. Probably by the time we get to it, the 17-day will be in this area right there, that 23.78% retracement. And then that's where we'll peak and then roll over, right? And then really break the 23% at that level, and then move all the way down to the 38 is what I'm anticipating. Looking at the directional movement index, again, you're above 30, you're below 15. The ADX is just getting above 20, so we're just now moving, right? Like the trend is just starting here. Same thing with the Qs. It's already above 25 on the Qs, and IWM is just getting above 20 there too. And you're not above 30 on IWM, you're actually below 30 on the negative index. Looking at the RSI and the CCI, you are at bearish levels, below 40, below minus 100. The NASDAQ, same thing, and the Russell 2000, same thing there. Looking at the Keltner channels with the Bollinger Bands, right? The Russell 2000, you can see, I mentioned this earlier this week, and it's continuing to be the case. You're trading below the Keltner channels and above the Bollinger Band, right? That's bearish, and you can see the momentum's pretty strong to the downside, about as strong as it gets. So, which means we'll probably get that kind of a move next week, sometime during the week. Might get us up towards the midpoint of the chart of the Bollinger Bandwidth, but probably nothing more than that. So don't be too, don't be thinking that this is the low point, as much as they'll bring on Tom Lee or whoever else when we do rally, because they'll say, oh, look, we're rallying and 2%. What a move. The market's really taken off. And no, it's just because we dropped that much today. That's the only reason why we will bounce. Whenever it is, we'll end up bouncing. Ichimoku cloud, we're well below the cloud. Remember, by the time we get to May, if we're below the cloud when it's green, that's really bearish. You can see we are practically the mature bearish trending mode right now. So you're above 80, which is what you look for there. You're almost below -5. So you're not quite there on the SPY. You are quite almost there too on the Qs. And then IWM, you're almost there too. They're all above 80 and all -4. So we are in mature bit trend mode. So any bounce you get, take it with a grain of salt. You're in a mature bearish trending move right now. Doesn't mean that you're going to go down every single day, because you can see you had one over here, and we didn't go down every single day, and you were strongly bearish that whole time. That's not how this works, right? You never go up and down every single day. When you're bearish, like we've been bearish pretty much since Thanksgiving Friday, and really since the beginning of the year. From that point right there, this January 5th day, that's the day we started to be bearish. And you notice there's a lot of green bars there. So there's going to be more green bars. Next week even, there's going to be green bars. In fact, next week's weekly bar, will probably be green next week. Because look, we've had 4 in a row of red. And that hasn't happened, right, this entire time. There's the COVID. You didn't get 4 weeks in a row bearish in COVID. There's your fourth quarter 2018. You didn't get 4 weeks in a row. You got 3, but you didn't get 4. There's your first quarter of 2018. If you go out to 15 and 16, we got 3 in a row there, but we never did get 4. And then when you look at 2011, we did get 4 in a row. Boom, 1, 2, 3, 4. 3 of the 4 below 3% for the week. And look what happened, the next week. You had a really strong move to the upside. So here we are, 4 weeks in a row. And I mean, they're not all hugely down. 3 of the 4 were down below 2%. Again, I would not be surprised if we didn't finish up 2% next week. And I don't think that would change. I don't think that would end the bearishness. I think we would just be getting closer to those moving averages. So big time grain of salt when you consider that. I mean, you look at the 4-week range here, and we are like a lower low today, lower high, lower low, closing below the low. We are well below last week's low. So lower high for the week, which ended up being pretty much yesterday's high was the high of the week. This is the low of the week. We're closing right at the low of the week. It's a lower high, a lower low for the week. I mean, we're below the point of control, or the value area for the 4 weeks. Can we go up to that? Sure. In the very, very short term, that we can definitely go up to that. But you can see the bearishness, right? We can see the bearishness there. If you take a look at today's volume, you saw the volume and, right here. the volume and trading range. The trading range ended up being well above the average, 14 points. The volume 144 million. So when you put those numbers in context, 14 points is off the chart, for where the average has been over the course of this past year. 144 million is also off the charts. The ATR is at 2%. So again, I don't be surprised if we don't bounce up next week. And like I said, we could very well finish the week up next week and still not be, this is hardly a washout. And in fact, I saw a former colleague talk about, this was a panic sell. No. Not a panic. This is hardly a washout. In fact, if you look at the volatility index, we finally closed above 100%. Finally. But we closed earlier in the week above 100%. And again, a washout doesn't occur until, remember how I said the fourth quarter 2018 ended? That correction ended with a washout right there. You can see we closed above 125%. That's where your washout is going to occur. So, the grid above 100% is pretty bearish from a market standpoint, but it's not really that bearish. That's not very bearish at all. In fact, the most intermediate declines, not market sentiment declines, corrections like we're getting right now, but most pullbacks, intermediate declines, most of those end or begin, either one, with the VIX ratio chart here getting to 105%. So the fact that we've only hit multiple times, but just barely over 100%, and then every time we've done that, we've gapped up above 105 and then closed below 100. Is that gonna happen next week? We're gonna open above 105 and close below 100? If we do, then you notice we're gonna probably get a drop in volatility. I don't think we'll drop down to 85%. The fact that we did that and dropped all the way to 80% is insane. And the VIX dropped all the way down to 18.5. That was insane. Pretty stupid. And so we're not going to do that again. Fool me once, right? But we'll probably drop back down towards 95% again. And then, like I said, then the selling will pick up. Then there'll be more of an extended move where we do break that 23% level and hold the breakdown this time. But I know we broke it today, but we're probably not going to hold it. We're probably going to come back up above it here next week. But then after that, probably towards May expiration, we'll start to work our way down and then break it and then hold that breakdown and stay down and hold the break below the 38% retracements on the NASDAQ and the Russell and move towards a 62% retracement. And again, all of them moving towards I've always been asked, how much further can we go? And I've been talking about this forever, right? I've been a broken record. I've repeated myself so many times. But when you break the 50, the correction is moving all the way to the 200, filling in that gap. That's a correction. The only reason why the correction will be so big relative to prior corrections is because the gap between the 50 and the 200 is so big. Because we moved up so much in such a short amount of time. 30% drop. Not all 30% drops are the same. This one, a lot of times you can get a 30% drop or more and be well below the 200-week moving average, like you did here. But this time you're going to get a 30% drop, and it's not going to be that far below the 200-week moving average, again, because the gap just got so big. But I don't believe we're done until you hit that 50% retracement, the 200-week moving average, which will probably be around the 50% retracement by the time we hit it. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that suggest why you're either a lot more bullish than I am or a lot more bearish than I am? All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us you liked the video today. It also tells us that you want us to do another video again on Monday. If that's the case, let us know. You can do it with one click right now while you're watching. If that's not the case, you don't have to click on anything. You don't even have to watch if you don't want to. Also, while you're down there, comment. What did you get out of the video today? What stood out to you? What questions or comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right. If you click on this icon, this Market Outlook Live, it takes you to this page. Monday, Wednesday, Fridays at 3:30 Eastern Time, I do a quick 10-15 minute live video. I do it right here on this page. You can see today's already posted here in all the archives. I take a look at all the trades from other Market Outlook videos. We see whether we should stay in them, get out of them. We also put on today's trade idea. You'll hear at the end of the video. We already put it on today before the market closed on this during this class as well. So you can also get to it here underneath Market Outlook live trade review in our main menu. Come over here. You can see our upcoming classes. Click on View More. There's our full calendar of classes here with going forward. We'll have May coming out over the weekend. Then you also have 4 years worth of class recordings going back. So quite a bit of content there. Come down to the bottom, click that heart, takes you to this tab. Hit that thumbs up icon, that heart icon right there. Also same thing, click that thumbs up right there. It takes you to this tab eventually. See, looking like it's having some issues there, but you can see this, hit that thumbs up icon, the like button on that. Again, the more you do that, it really helps us out because it gets our content out to all of our followers, to everybody who follows us on Twitter and Facebook. That's why we always ask you for it. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here while you're watching. You do this right now while you're watching here. All right, now let's take a look at what's driving this price action here. And you can see this is the week that we had. Look at the strong rally. The dollar didn't go up today, but it was up most of the rest of the week. But interestingly enough, so were commodities. I shared this in class. There's been a couple really strong dollar rallies in 2014 to early 15 to 2018, those periods. But those two other periods where the dollar was really strong, commodities were down like 30%, both those periods. But not this period, right? This strength, this dollar strength that we're getting right now is actually associated with really strong, and bonds really rallied at both those other strong dollar periods. Bonds are down during this. Now, they're not down compared to stocks, but they're down on the absolute basis. Yields are up and commodities are up. So it's pretty rare for commodities and yields to be up, which is an inflationary pattern, but for the dollar to be up too, because when obviously in an inflationary environment, the dollar is bearish, right? That's inflation means that the currency is losing its value. But the dollar's been strong during this inflationary environment where commodities and real estate, for that matter, is right. But look at real estate. And real estate had the worst week of all, down over 5.25%. Then there's Qs and IWM both down 4% practically. Emerging markets, the only one, which is also another crazy non-dollar strong dollar pattern, right? When emerging markets are outperforming, equities, U.S. equities especially, with the dollar up 2% for the week, then you know something's up, right? In terms of that dollar strength. And we know what it is, right? We know that a lot of this dollar strength that we've been getting over the last however long it's been going up has been mainly associated. The reason why is because of tremendous weakness in the yen and the euro. And this week is especially the euro. But if you were to go back, however long, year to date, it's really been the yen that's been the killer. It's been getting killed, just absolutely killed. You can see the South African rand, the Mexican peso, Canadian dollar, all pretty bullish, relatively speaking. But the euro and the yen, which make up 70%, those two currencies alone make up 70% of the dollar index. So when you see the dollar going up, what we're really seeing is the dollar yen and the dollar yen going up and the euro US dollar going down, right? We see those two currencies, the euro and the yen, dropping. That's been the biggest reason this week, especially because of the euro. The euro's been just absolutely bearish. And the yen has been both, really for that matter, both of them have just gone extremely parabolic, right? If you look at the US yen, how parabolic, the ADX is up to 70, which is just insanely high. The euro US dollar, you can see, its ADX isn't very high, but you can see the negative indicator got pretty high, the positive got pretty low. That's a pretty high level, a pretty wide gap for the euro US dollar, because this is so liquid, right? This currency is even more liquid than US yen is. So really, pretty parabolic moves. In fact, when you look at the RSI for the dollar index, it got up to 80 yesterday. And when you look at the Euro US dollar, it got down well below 20. The Euro US dollar, well, it got down to, below 25. It got down to 23, which you can see is a pretty darn low level for this currency pair. Look at the US yen. Look how far up it went up to. It got, all the way up here, way above 80, up to 86 before this last little move. So very strong RSI levels, again, for the dollar against a lot of these other movers. Look at the Japanese yen. Again, that's to get the trend quality to up to 27. That's unbelievable. Go back 20 years, and you can see we haven't had, we had really, we're at 27 right now, so we're right about in this area. That's about the time. 2012 is about the time that we've had this big of a rally, and the rally didn't end. It just got really volatile at that point. The ups and downs, and then you had this tremendous triangle pattern that just went sideways for so long there in 2013 during QE. We're not going to have QE right now. We're going to have quite a bit of rate hikes, which is going to drive a lot of people towards safety. In the case of this currency pair, the yen is the safety, and that yen's up at 130, which, again, 130. This is 125, 126, 130. Last time we were even close to 130 was back in 2002. It's been pretty much since 2000 that this pair has been up towards 130. It got up to 135 in 2002 at the very low end of that bear market, right, in U.S. equities. And you can see the yen went all the way from 135 to almost parity there. That's how strong the yen rally off of these levels where we're currently at right now. So I would expect you're going to get quite a bit of demand, not only for the yen, but also for the euro, considering how low these levels are. The euro's at 105, as much as I would love to go to Europe right now. That we were there in 16 and 17, and you can see the move up to 125 at that point. And then 105, the last time was in 2002. The same level that we were at against the US yen when it peaked. And so you can see the kind of move that you can expect to get out of that. The dollar, these currencies are about to find a lot of demand, and the dollar is gonna it's peaking again because those two are just so bearish. Like the U.S. dollar ETF, which we don't have as much history on, it goes back to 2008. Up at 27. That's not so extreme. We were at 27 over here at the worst of the great financial crisis. Was the last time the dollar's been this bullish. We are hardly at the worst of a financial crisis. We're just barely starting a correction, much less being at the worst of a bear market. We haven't even started the bear market. You have to have a correction. You have to have a failed correction bounce. Then you have to break again into a bear market, start a bear market. And then the bear market ends with a hurrah, with a washout, right? Whether it's October 2008, July 2002, you just have a tremendous washout. That last time we had one of those tremendous washouts was the last time the dollar's been this bullish. So I think the markets have priced in, and you see that with the bond market. The bond market, the dollar, these have all priced in what we're about to get, right? What we're about to get in terms of these rate hikes and then the stock market's reaction to those rate hikes, largely priced in. When you take a look at the only one that's not priced in is the equity market, right? That's the only one who's not priced all this stuff in. When you look at the sector comparison, again, just looking at this week here, you'll notice that the biggest loser was discretionary. Amazon helps with that. Tesla too. You can also see real estate down 5.5%. Financials down. Utilities were down 4%. So again, that's not your typical risk-off pattern. If you look up here at the top, XLK was one of your big winners, and XLB and XLE were your other big winners, which again is not typical when the dollar is up 2% for the week. So this, if you were to look at every other asset class and market and sector move besides the dollar, everything else, you would see all these other performances and think, oh, the dollar was down this week. It was probably down pretty big, except for gold. Gold was down, but commodities and bonds and everything else. This sector rotation, oh, the dollar must have been down. Nope, the dollar was not down. The dollar was actually up quite a bit up, and it put a lot of pressure. And to see utilities and financials together, and those are two sides, two opposite ends of interest rate sensitivity, and they're both down. Kind of goes to show just, again, when we're bearish, everything goes down, right? When you're bearish, we didn't have that. That wasn't the case because energy had been so bullish during that previous move. But when you're bearish, everything is dark pink shading in a red line. Everything, including utilities, including real estate. Now, these might not go down as much when it's all said and done, right? You might not have as, you have double-digit numbers up here, 20% for XLC. You're only down 1.5%. You're actually up 3% on utilities. So we might not go down as much down here, but they'll still be dark pink shading in a red line, and you're seeing that. The only thing that's not a red line right now is energy, and it's close. And the only thing that's not dark pink shading and red line is staples, and it's, obviously it's a pretty bearish close today. So you'd expect that we'll get there. So looking at this, we are in correction mode. Nothing is unscathed right now, which is a very typical pattern of corrections. All right, now let's take a look at our trade idea of the day, and I wanted to look at Intel. Intel has got a very interesting chart. Obviously, it's turning dark pink shading in red line, though it's 9% below its moving average. It gapped down on earnings, really bearish, right? The intermediate line in the low reversal zone. If you take a look at its weekly chart, look at this. This is the thing that really stands out to me. Look at this breakdown on a weekly basis. It's one of our lower closes we've had. In fact, I think it is the lowest close, 44.04 over there, 44 there, and we got to 43.5. So this one we got to 44.28. So this is the lowest close we've had in the last 5 years. We're not closing below a lot of lows, but it is the lowest close. Obviously, dark pink shading in a red line. Market sentiment's bearish. You're in a bearish trend, right? You're in a death cross environment and have been on Intel. But we are really, really breaking down. Very bearish Hakenyashi close there. If you look at the Bollinger Bands, let's go 5 years though on the Bollinger Bands. Intel, sorry. You can see you're breaking below the value area of the last 5 years. It's been a very sideways moving stock, up and down within it, but pretty sideways trend. You can see it's one big node right around $50 has been the point of control. We're below $50, but we're also breaking below this $44, which is the low end of the value area. Now it's not quite, it's not exactly a huge breakout, but there's just, notice there's no volume below here. We moved up so far so fast back here in September and October 17, that there's no support down to $35. So really, really easy for it to make a move. And you have, all these directional patterns showing that we're breaking out above 30, below 20 on the DMI. The ADX is well below 20, so it's ready to make a trending move. The trend strength indicators they still haven't gotten to mature levels yet. We just barely got the intermediate trend strength today, below -2, above 65. So you could argue that we are just starting a trending move right now. You can see below 40 there on the daily chart and on the weekly chart, and getting below -100 again on the weekly CCI. So bearish moves across the board, and again, considering the lack of volume below us, what I decided to do here is do a pretty aggressive bull put spread or bear put spread. So buying the $40 put for June, not quite at the money. It was kind of at the 42.5 was pretty close to at the money, so not quite at the money, going further out on the money, and then selling the 37.5 to lower the cost. So it keeps my risk really small, and I get a pretty decent reward if it works out, over $2,200 if we end up closing at June down below this 37.5. So it can't just touch there. It's got to stay down there by the time we get to June expiration. So an opportunity for a really good return, if this works out and, like I said, the stock stays bearish, stays below these moving averages. And, we're just barely starting a death cross environment with the 50 here breaking below the 200. On the weekly chart, right? On the weekly chart, not the daily chart, but on the weekly. Obviously, in the daily chart, we've been death cross for a long time. But on the weekly chart, we are just barely starting, which means Intel is in a bear market, right? Here's your correction. Here's your pullback, and then failed pullback bounce. There's your correction to the 200-week moving average. There's it actually went a little bit below it. There's your failed correction bounce back up to the 30 and 50-day moving or 50-week moving averages. And then now you break back below the 200 and start, now you're in a bear market. It's been in a bear market pretty much all year. And, again, there's no support below to keep you from extending in a bear market, right? For this individual stock, a bear market just for this individual stock. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. You can also subscribe to our website at marketscholars.com for free. Like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.